Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today on the Econ Show, there's a lot of stuff to cover from the U.S. perspective as well as global, but they're especially on the China front. So we're going to break it up into our 5 segments, and we're going to look at global central banks. They keep tightening, but really, what does that mean? Where is inflation going? What does that mean for liquidity and growth? Because there's a lot of nuance within that. Then we're going to move over to the Fed and look at how is the Fed starting to pivot. We saw that there was some commentary in the Fed minutes in terms of the pace in which we're increasing and what is happening to retail sales. Because yes, the nominal number continues to go up, but the actual the adjusted for inflation number continues to go down. And this comes back to what we've been talking about, and you're probably sick of hearing me say it, but there's value versus volume, and the volume continues to diminish. Now on the real estate, then we're gonna go into the real estate data, which continues to weaken. And if you think of the real estate moves as kind of the leading indicator, then there's just more pain ahead for the U.S. economy. And then the European pain lives and dies on electricity prices at this point, which have continued to move parabolic. So we want to talk about electricity prices as well as things that are continuing to shift on the economic front. And then we're going to pick up with China and Asia in general, but really we want to talk a lot about the recent Chinese data, which was a huge swing and a miss, and what that means going forward as we see more pain ahead for their economy. So now when we just look and just kind of look at the broadest tightening cycle, I think this is a really good chart because it shows the broadest tightening cycle in history. So this is the fastest, and it just in terms of pace, as well as most aggressive world central bank hiking rates ever. And again, that's not surprising when you consider that this was also the greatest easing in history. So you're on both sides of this coin now. The question is what happens to the economy going forward? Because so far, even though we've had this very aggressive hike in rates, we haven't seen a big pullback in inflation, and that's where we continue to see some of these pressure points that continue to arise. In the next segment, we're going to talk about flexible versus sticky inflation in the U.S., and the same can be said globally. The problem is right now, even though the flexible inflation has started to diminish in some of these areas, it's being driven by gasoline and diesel, but not food. Food continues to be a huge overhang for a lot of these nations that continue to tighten, and they're using a lot of their foreign reserves to try to just stabilize the currency, which is just increasing the economic pain that we have as the developed markets continue to slow. And as they slow, it means they buy less stuff, which then, again, it continues to go back. And for those that have been watching us religiously, you've heard us talk about how a lot of this starts in the developed world and then trickles down. And that's where we're continuing to see this trickle down effect on a negative side, where it's just their exports are getting hit, which is increasing the pain locally. So then when you look at the liquidity, we're just not seeing any real liquidity turn up. And they're trying to do 2 different things. So you have a tightening cycle, you have the local governments trying to fund some debt, trying to push some through to try to offset some of this. But again, they're caught in between a rock and a hard place, because it's like they don't want it to go too far down, but they can't let it go too far up, because they have to take some of this currency out of the cycle, out of the world. And that's where liquidity conditions are continuing to show that there's a lot of pain out there. And we've had a very strong rally when you look at emerging markets, when you look at the U.S. But when you look at how liquidity is and where those leading indicators are, there continues to be more pain coming forward, which is why it's not surprising to see that global economic confidence continues to weaken. And typically the consumer is a bit of the leading indicator to this, but businesses are just now starting to see the pain, and this is the timing delay. So the consumer will start talking about being concerned, but they won't spend like they're concerned yet. because there is a desire to maintain lifestyle, to say like to not admit things are as bad as they are. So the consumer holds in, especially, and this time around it was even extra different, if you will, because there was a lot of government money that came out, which a lot of individuals were able to pay down their debt. Their credit cards, they were able to pay down their, put some extra into savings. So even though they're feeling worse, they're less confident, they do have more money to spend. And businesses were seeing that, and so their confidence was a little bit different. But that's where, as that diminishes, as inflation continues to bite, that's where you'll see the business confidence come down. And we're already seeing it in the U.S. with CapEx expectations, with CapEx guidance. We have Federal Express, FedEx. What are they doing? They're cutting. They're increasing their I think they call it their Christmas surcharge, which normally happens in the last week of October. They're going to start it in September 5th. The day, or I think it's the day after Labor Day. So again, they're pulling that forward. Amazon has said something similar. So you're starting to see these companies trying to just mitigate against these increased costs, which again is going to go down to the business, because businesses, I know as a consumer, if I have to pay for shipping, I won't do that, or I'll complain about it, or some of these companies will have spend a minimum and then get free shipping. Will they do that? Will they continue to pass on these costs? Again, CapEx hiring is also slowing, continuing to cut. And that's not something that is changing. And I think it's important to think about where the conversation continues to go. So according to Bloomberg, transcripts of U.S. companies' earnings calls and presentations, onshoring, reshoring, nearshoring, are being thrown around more often than ever this year, exceeding levels seen in the early days of the pandemic. So those that have known me, I've only had the YouTube channel since 2020. Back in 2016, and just to give some color on this, I wrote a thesis back in college in 2005 that we were going to come to an end of globalization. And not that globalization was going to stop, but we were going to get to peak and really excess opened capacity in China by 2016. And I was looking at the rate of change when you look at wages, when you look at pollution, living standards, and that the cost of being in China was going to continue to increase, eventually making it where it was no longer economic to maintain the level of activity in China. Not that they weren't going to be a big component of the supply chain. It's just you were going to actually start to see a bigger pivot outside of China. So my view was that 2016 was based on the econometric project I did. 2016 was my year. And then obviously I was early, and it ended up being, we started to see this in 2018 and 2019. And then everything really started to accelerate, obviously, with COVID, waking people up to the fact that, hey, it may not make sense to have all of our eggs in this basket. Let us start to diversify, which is why, and we were talking about it on Twitter, Vietnam became kind of our focal point. And this is something, and the reason why this is only talking about the U.S., but this is in the global section, is because the U.S. has a lot of global entities. So this is going to impact a lot of areas for the better and for the worse, because we're going to see this rejiggering, and we continue to see the different shifts in general, where people continue to move out of China into other areas, into different places, especially Vietnam, and that's something that we're seeing. And I think we had a chart, I think it was 3 weeks ago, where we showed that the countries that people are talking about this, China is number one, but India isn't on it. And so we continue to see India as an entry point, not an exit point for this shift. And the reason why this is important is when you look at the countries and how dependent they are on the Chinese export markets. So when you look at China, China is an area that the EU has been relying on when you think about how China's been importing their products. So when you look at imports, which are just absolutely destroyed, and now when you look at how much pain the local consumer is under in China, that is going to keep pressure across the board, which is why we do expect to continue to see the issues arise in Europe. And we think that there's going to be more problems for the European Union when you think about as China going away, China slowing, that is going to continue to keep the pressure here and again, put pressure on the European markets. U.S. steel demand from construction, steel price. So as we've been saying, construction is slowing. We're going to talk more about it on the real estate section in segment 3. But it's not just the U.S. We're seeing those issues, broadly speaking, especially in China, which is why we do expect to see some of that shift, of that excess capacity in China move into the global markets. And then when we look at the U.S., check-in to offices have fallen in most places. And I think we're starting to get to that stabilization side. We will get an increase when you think about people coming back to work. We're coming to the end of summer, but when you think about where places have already gone back, Atlanta, other places in the West Coast, and you're not seeing that huge step up. Again, I think as we go through September, you'll start to see things creep back up, but it's just showing how the market has changed and why we continue to think that we're not going to get back to that quote unquote normalization when you think about gasoline demand, because people aren't driving as much during the week because they're not going into the office. So then the global oil market balance, there's an expectation that you're going to get a surplus as we come through the back end of 2022, and then you're going to see some of that then fall off in 2023, which I think is a likely scenario. And for those that have been following us on the EIA show, we've been talking about the issues in the diesel market, but then the offsetting issues in the gasoline market. And so diesel is going to continue, gas oil, distillate is going to continue to be in a bright spot while gasoline builds maintain this upward trajectory, creating a lot of this pain and this separation. And that's where we see that there's going to be that slowdown, with China being the biggest driver of we're not seeing a lot of buying, which is going to increase the amount of crude in storage. We've already seen it happen in floating storage in the Middle East. We're seeing it in floating storage and onshore storage within China, and we don't see that stopping. And the reason why we talk about this here is because economic activity is a direct correlation with what does the oil market look like, what does gasoline, diesel look like. And that's where China, being the largest importer of, outside of the U.S., obviously, the second largest importer, but the biggest growth market for crude, and just the issues that they're continuing to face, we just don't see this as, obviously, as a big throughput, especially as people aren't driving as much, and the economic pain hits many of those individuals, which will limit the amount that they go around and actually move about and drive. But it's a haves and have-nots, because any crude that yields a high distillate cut is going to be high demand, and we're seeing that in terms of the spreads, where things that have a high gasoline cut are going to come under more pressure. And when you think about why that is, you have to look at the indicators and some of the pressure points when you look at food. So when you look at food in general, for the emerging market side, food is a huge hit to the underlying market, because the top left looks at how much does food make up of the inflation basket, and for emerging markets, it's massive. And I don't think that's surprising, because we did a whole show that typically 80 to 82 cents of every dollar in a lot of these frontier markets goes towards food, for every dollar earned. And that is a huge number. And when you look at where food prices are, that continues to be a pressure point, which is only made worse with the dollar continuing to remain. Right now, it's back over 107. And as we've been saying, it's going to stay in this elevated range because you have central banks purchasing dollars, trying to adjust for the fact that their foreign holdings are coming down, because emerging markets are spending dollars to buy their local currency. and then they have to go out and replace those dollars, and that's just keeping this inflationary pressure with the dollar so elevated, and a lot of commodities trade in dollars, and that's only going to make that pain for the food side when you're looking at how they purchase, when you look at how that cost is passed through. That's going to maintain that pressure point, which we've been highlighting on the food front. Weaker demand than supply undermines outlook for chip makers. So when you start looking at chips, Apple has talked about moving some of their production of Apple Watches into Vietnam, and you're starting to now see us flip from the shortage to glut when you look at chips. And one of the things that we've highlighted from last year was that we were going to have a chip problem until really the middle of this year. And now you're starting to see that come full turn, if you will. And now we're starting to see those supplies really start to ramp up, creating a lot of these pressure points. So when you look at U.S. feed, grain, and corn supply, you can see here that things continue to diminish when you look at the projection into 2022, 2023. You're seeing a lot of those issues when you look at millions acres planted, harvested. The yield continues to remain fairly stable, but the actual area that is harvested and planted continues to come down on feed grains, corn, something similar. Now, the WASDE had come out and you had some decent numbers for soybeans, but for wheat and corn, we continue to see a lot of these pressure points, and that's not really changing. And again, not that the U.S. can't feed itself, because it can. It's just how much do we have excess to export? And that's where we continue to see this conundrum in terms of where the quality is, because the quality of the crops is very much dictated by this chart. Very little rain in large parts of the U.S. Nearly 70% of the country is at least abnormally dry, 40% in severe drought or worse. And this is impacting a significant amount of the country and the ways in which they operate. And this impacts yield directly. So there's on the private equity side, one of the companies we're invested in, Soltec, their product is actually really good for droughts. And one of the issues that we're seeing and why we invested this way is that droughts and excess rain is becoming more common. So you need a fertilizer and you need to plant accordingly with the expectation that you could have one or the other, and you need a product that is going to manage in those extremes, which continues to be the case here. Now, this is also impacting just, again, yield, which is why we see more pressure abound. Now, delivery times are still high, but getting better. And when you look at just the different areas, this will help pull down some of the supply chain issues. But there's still some of that cost that's going to remain, especially when you look at wages and some of the others. But this is a net positive when you look at the supply chain, things catching up. We've seen it in the manufacturing side. We've seen it on the real estate side where things have started to get a bit better. And that's something that we think is going to only continue to improve. Processor chip manufacturing capacity, obviously Taiwan and China and the U.S. The U.S. is looking to increase, but this is why Taiwan is of so much interest when you look at a potential blockade with China, when you look at how Taiwan could react. What does this mean for global chip production? This is why Taiwan matters so much to the global world, because there's comments where it's like, well, it's China's business on what they do with Taiwan. It's like, well, if you like your TV, your car, your phone, your watch, at this point, your light bulb, your Nest piece, the Nest for heat and cooling, your thermostat. There we go. That's the word I was looking for. You should care. If you worry about the missiles that protect your country, if the protection that, again, there's so many things on why the world is going to care about Taiwan, given how they're positioned on the chip side, which is why it matters so much. Now, when you look at the share of the global economy in sequential contraction, it's continuing to go up. And this pairs with, again, tightening of different things, inflation remaining sticky. This is why when you look at central banks that are bleeding through their foreign reserves, especially dollars, it's because they're trying to backstop. It's because they're trying to do different things. But that's where we're seeing subsidies cut and all of these pieces that as they roll through, they're going to put more pressure, more pain on the underlying economy. Then when you look at the G5 credit impulse, both inflation and growth will drop hard, and you're just getting more and more backdrop of this isn't going to be a soft landing. And we are firmly in the belief that this is not going to be a soft landing, even as much as the Fed tries to pitch it as one. The euro area, when you look at in the US, we continue to see a big increase in inflation, but it's important to look at the euro area, which is being driven by energy. And even as gasoline and comes down a bit, electricity and natural gas are completely and holistically replacing any benefit you're getting from a gasoline price as electricity and prices reach new massive records. And I'm talking about huge records that are going to just inflate the price of everything in terms of what the consumer purchases directly to power their home, to all of the goods and services that are used, and again, increasing the price to the consumer. And this is just keeping that margin pressure, CPI less PPI. Energy costs remain an enormous headwind for European equities. So again, I don't see how this doesn't continue to roll through. Obviously, the market is ignoring all of it. And it's at some point, there's going to be this massive makeup trade. And these are some of the key pieces that we continue to look at. And as the benchmark interest rates in other areas, including Latin America, move higher, I think now at this point, they were so aggressive so early that you're going to see them flatten out. See how the market kind of tolerates the things that have been done. But given inflation in a lot of these areas, including Mexico, ran up again, we do think that there's going to be another shift up. So this is the, again, Bloomberg economist surveys. I think that they're missing some of the recent data, and not to say that these are wrong, but the new data is indicative of, I think, of several more raises. So we will get this next shift up, which is only going to put more pressure on that local economy as well. The latest EU gas storage data, again, things are fairly in line, but the problem is what happens if you have a cold winter. There's a concern about what that winter is going to bring, which is why they're putting things in place now. Because typically, if you have a cold winter, you'll pull additional from Russia on the pipelines. You'll pull some additional down from LNG, but you don't have that pipeline option right now. Now, could it change? Sure. Russia and the Ukraine have said that they're open now to direct negotiations between Putin and the Ukrainian president. I don't see that changing. Right now they're in a pretty stagnant stalemate right now. The Ukrainians have made some inroads. The Russians have made some inroads in different areas. And again, kind of that swap back and forth continues to be the case. So World Fertilizer Index has pulled back a bit, but you can see it's pulled back just from the massive highs. So the World Fertilizer Index from IMF has rolled over, falling 10% from its recent peak, which nearly matched the great financial crisis. But given what is happening in Europe and the cut in activity, there's capacity there. That's where we're going to continue to see some of this overhang. And now thinking about that back to the U.S., the corn condition index scores are near the lowest of the past decade. When you look at the U.S. and final yield, this is where we've been talking about that we see pressure to the final yield. And you can see that there's an assumption that yield is going to stay fairly flat to last year. We just think that there's going to be some of that downside surprise, which is going to impact, again, the global markets as we see a lot of that pricing remaining fairly sticky. Bloomberg Agriculture and Livestock Index has come down with the CPI food consumed at home remaining elevated. But there's a bit of that disconnect because even though the index has come down, it's now starting to come back up. So there is some downside to the CPI number, but again, it's just going to be a matter of that timing because some of it is coming back. Eggs is one that was elevated significantly, starting to come down. And then when you look at the USDA versus the survey, when you look at corn and you look at wheat, this is where, given again some of those down moves, you'll see some of that correction back up in terms of pricing. Soybeans being so elevated help pull things down in general, but corn and wheat remain the problem. And then again, that corn issue that we just talked about in the US, with typically this is a big crop that we export. is going to weigh on the international world. So the Taiwanese electronic optical PMI, so global semiconductor producer stock price, this is where you're seeing some of that pressure. Again, that flip that we had been talking about that was going to happen really by the middle of the year. Now it is firmly happening. Then when you look at capital flows, Chile has had a lot of capital outflows in terms of some of the different pieces and inflows in others. And the issue is now going to be copper. What are we going to do about copper? How are we going to ensure that there's enough? And then when you look at portfolio flows to emerging markets, things have been a bit of an outflow, most of it being driven by China and emerging market debt. But when you look at emerging market equity, excluding China, you've actually had some inflows, which recently, but after some consistent outflows, you'll get some of those shifts back. But this is where we do continue to see pressure ahead. Economic lifeline, when you look at the Rhine, some of these areas have gotten a bit compressed. Some places saw a little bit of a reprieve, but it's coming down, in terms of where some of the issues are. And again, this is just impacting the amount that they can move through the system, the amount that again, this is just going to add additional to cost. Then when we look at water levels at the Rhine waypoints, fall to season record lows, and that dotted line is where you have to actually stop, and they're hitting some of these areas in some key points, which is again creating the pressure, which is going to impact just the amount that can be moved on that on the river. Increasing cost, increasing supply delays, delivery time delays. So even though things on a holistic level are getting better, this is where they will continue to get worse. So that's what we have here on the global front. In the next segment, we're going to go deeper into the U.S. and what has happened with the Fed and retail sales.